Greetings, everyone, and welcome back to the 69th episode of the Meet Kevin Report, coming to you from none other than a dungeon. It is also April 1st, so today is my anniversary. April Fools. Actually, that's true. I did meet Lauren, and well, we met a few days before April 1st, but we were officially boyfriend and girlfriend on April 1st. So, kind of cool. Anyway, get this. The average bonus for a New York securities industry analyst, what do you think it was in 2022 versus 2021? Now, what I think is really interesting about this is I want you to ask yourself, why am I not in that business, right, as an individual? Listen to this. If you were a securities analyst, so you got yourself a series license and you got into dealing with stocks in New York, the average bonus in 2021 was $240,000. That was the average bonus. The average bonus in 2022 went down to just $176,000 bonus, but still pretty incredible. Kind of makes you wonder, dang, I got to get into some securities here. Then listen to this, is also quite unique. The New York Times published a story in their business section yesterday talking about how publishers and a lot of companies, not just publishers being newspapers like the New York Times, get about half of their traffic from search engines. Yet, they expect, because of fuller results by chatbots, we might actually see even less mainstream media profits thanks to chatbots giving people more detailed answers. Pretty wild. So, unfortunately for the mainstream media, it looks like ChatGPT might be coming for them. Although a lot of people would probably look at that and go, you know what? That's quite all right. We want the mainstream media to have some competition. Hopefully, commentary will still survive. So, uh, let's get into some of these specific topics. If everything sounds okay audio-wise, maybe give me a little heads up there in the chat if you don't mind. Hopefully everything is great. I expect it is. At least I did test everything. It's always a little harder when I'm traveling, but I do my best. So, without further ado, let's get into the first topic I want to talk about today, which is Elon Musk getting rejected. Well, Elon Musk was rejected again regarding Twitter. Elon Musk tried to meet with the head of the good old FTC. This is an organization Twitter has had a long history with. Back in 2011, there was an investigation into Twitter about privacy concerns by the FTC, the Federal Trade Commission. And apparently, Twitter paid a $150 million fine. That's a massive amount of money, mind you. $150 million fine over alleged violations of a settlement that Twitter had with the FTC in 2021. Now, that agreement was expanded to prohibit Twitter from using certain data like targeting ads. However, a former chief security officer at Twitter whistleblew Twitter and basically brought the FTC right back into investigating Twitter. Now, Elon Musk is taking a very business-like approach, which is, all right, look, if we've got a problem with the FTC, let's set up a meeting with the head of the FTC. And if we set up a meeting with the head of the FTC, then maybe we can get to the bottom of what the actual problem is. Well, unfortunately, the head of the FTC rejected Elon Musk from meeting her. Instead of actually providing any kind of communication to Elon Musk, her response was simply, no thanks, go ahead and comply with our regulations, and then we'll consider meeting with you. That's because right now the FTC is actually taking potential enforcement action against Twitter, multiple cases from the FTC against Twitter to investigate their compliance with trade laws. Now, what's really interesting over at the FTC is the fact that it's become a little bit of a hotbed in terms of potential polarization. And the way to potentially look at this is by examining the letter from the former commissioner of the FTC who resigned at the beginning of this month, just March 2nd of 2023. The previous commissioner of the FTC bailed out. Now, this is interesting. So let's go ahead and put this up on screen here. Let's see how we're going to go ahead and do that. I believe if I push this button, yeah, this is very nice. Okay, good. And then I can throw this button on. Oh, look at the travel studios kicking butt. By the way, if you like the way I can set up this travel studio, a lot of this is actually thanks to StreamYard. So big shout out to StreamYard. You can learn more about StreamYard by going to metkevin.com/StreamYard. They are a phenomenal way to record and live stream. So shout out to StreamYard. This is the platform I use. Again, that's metkevin, M-E-T, kevin.com/StreamYard. Give him a check out. I think you'll really enjoy him. So anyway, take a look at this particular letter here. This is the former commissioner of the FTC. And what do they have to say? They talk about how they're on their third tour of duty at the agency, and they believe in this agency as the little engine that could. But unfortunately, it seems that after the Biden administration took over, some things started to fall apart at the FTC. Remember, this is the Federal Trade Commission. For example, the Trade Commission has very particular rules, such as when I get potentially paid to say, go to metkevin.com/StreamYard. I should potentially also throw up this little banner here, which says paid promotion. Hey, look, I fixed the spelling. Anyway, so the FTC here says, in 2020, 87% of responding employees agreed that there were high standards of honesty and integrity. In 2020, 83% of FTC employees agreed that there was a high level of respect. And in 2020, 80% of FTC respondents agreed that senior leaders generate high levels of motivation and commitment in the workforce. Well, unfortunately, after the Biden administration took over, those numbers almost halved. In 2021, high levels of standards for honesty and integrity fell to 53% in 21, 49% in 22. High level of respect fell from 83% to 49 and 44% for 21-22. And generating high levels of motivation fell from 80% to 42% in 21 and 36% in 2022. In other words, the FTC here is making, or the former FTC chairperson or commissioner here is making the argument that, look, whatever happened since Joe Biden came in and suggested that we were going to sort of minimize some of the divisiveness in our culture has actually reduced the efficacy of our agency's trust in each other. If anything, it's become more divided and at the same time less motivated. In fact, they go as far as saying that in 2020, the FTC brought 79 consumer protection actions. But in 2021, that number declined by more than half to just 32. The number did increase in 2022 to 46, but still well below the 79 actions taken in 2020. Here, the commissioner is really arguing the FTC is becoming less functional for some reason, whatever the reason is. But as soon as the Biden administration took over, under that leadership, whatever happened, whether it was the political environment, whether it was the Biden administration, nobody knows exactly whom to blame. But for some reason, this commissioner is resigning under the argument that the FTC is becoming much less efficacious. In fact, they say that fraudsters doubled down in 2022, and consumers reportedly lost $8.8 billion to fraud, an increase of more than 30% from the previous year. Yet the FTC took a fraction of the actions that it previously did. And as a result, for the sake of the American people, Mr. President, I wish you success in the remainder of your tenure. And I implore you to closely examine the developments at the Federal Trade Commission to ensure that your vision of a return to normalcy is being implemented with care. This person, by the way, is not very excited about the new commissioner, Mrs. Khan. Mrs. Khan was appointed by the Biden administration, and Mrs. Khan is actually the individual who rebuffed Elon Musk from a meeting, suggesting, well, deal with the enforcement action first, and then we'll go ahead and consider any kind of commentary from you, Mr. Musk. Now, what I think is really interesting about this is usually what you find when you have an agency investigating somebody like an Elon Musk. You usually have bureaucrats who are doing the best possible job that they can, but they are bound by bureaucratic processes. And entrepreneurs generally don't mesh with bureaucrats. That is nothing to say that bureaucrats are bad people. It's not to say that entrepreneurs are bad people. It's just to say it's literally like trying to put a square peg in a round hole. It just does not work. Entrepreneurs look, what's the problem? Let's figure out how we can solve the problem and let's just implement it the next day. If that means we have to flip flop, if that means we have to change our mind, if that means people have to get fired, if that means things have to be broken to get it right, that's what we're going to do. Because ultimately, the goal of an entrepreneur is to make sure that the enterprise makes as much money and provides the best value possible to its users. The best money is important for not only its employees, but also its shareholders. And of course, providing the best value is important for society. However, of course, we do have regulation. And the role of a bureaucrat is to say that, well, that's fine. You can have the motivations of providing the most value and providing the most shareholder value, so consumer value and shareholder value, but we have to do so within the scope of our rules. And if the scope of our rules are ones that suggest you must do things a certain way and you must meet our check boxes, then we're going to continue to bug you until you complete our check boxes. And Elon Musk is trying to essentially suggest, yeah, I'm just going to try to go to the commissioner here and maybe we can just work this out. And quite frankly, that is very common for an entrepreneur. An entrepreneur who goes and pounds the table at like the city building and safety office and says, I want to talk to the manager, usually actually doesn't get very far. With bureaucracies, you have to earn your respect from the bottom up, not from the top down, which in entrepreneurship, you get much more of sort of a top down style of governance. In bureaucracies, you have to earn it from the bottom up. Everyone at the bottom has to like you for the next levels to like you, and the next levels to like you, and the next levels to like you. And it's hard because you basically have to please every bureaucrat along the way because all it takes is one bureaucrat really hating your guts and you're screwed, right? So, I mean, that's just the nature of government. But Elon Musk clearly exhibits his frustration over this. And so you could see potentially the failing of the FTC here in really doing anything based on what the FTC is suggesting here, even though they're investigating Twitter. Is it possible that they might get less done under this new commissioner whom the Biden administration appointed because of the internal strife at the FTC? Yes. Could that sandbag Elon Musk even more? Absolutely. And I think that's an important takeaway here is that the more Elon Musk gets sandbagged by regulators, the more risky it is that Twitter ends up losing money. And the more risky it is that Elon Musk ends up having to sell Tesla stock to support Twitter. Now, keep in mind, Elon Musk has made a quote unquote promise. He has obviously the right to change his mind. Quote unquote promise not to sell Tesla stock in 2023. I personally believe that Elon Musk's selling of Tesla stock, $24 million in 2022, was exactly why Tesla plummeted to the core of the earth at $105 at a low. And as soon as we had tax loss harvesting in December, which amplified that effect along with shorting, and then that flip-flop of short covering along with re-entering in January, we've seen a recovery. That can all change if Elon Musk is forced to sell again. That's why I personally actually am paying attention to what's happening with Mrs. Khan and the FTC. I want to pay attention to this mostly because I am exposed as a Tesla shareholder. And so I'm going to watch what the regulators are doing with Twitter because unfortunately, the nature of regulation is one that does not play nice with entrepreneurs. Regulators do not like people who are trailblazers, dare we say. When you hear the word trailblazer, try not to think of the car. Try to think of somebody who's doing something that just isn't, it doesn't have a clear precedent yet. To some extent, crypto is like that with the Securities and Exchange Commission or even the Commodity Future Trade Commission. Neither agency really knows who has the power to regulate crypto. And Congress isn't going to do anything to suggest anything either direction. So the only way the CFTC and the SEC can actually get to the bottom of what their role should be is by basically asking the court systems to decide. So it's very understandable for the SEC and the Commodities Future Trading Commission probably to file endless more lawsuits for crypto-related claims because really they're trying to, in some extent, find their place via the judicial system telling them what to do. And it's possible that the FTC will do the same thing with Twitter, which unfortunately becomes very expensive and very painful. So I think that's something to keep in mind as an investor in Tesla. Keep in mind also that there are a lot of news organizations and even um, prolific athletes who are suggesting they are not going to pay for Elon Musk's blue check mark. For example, LeBron James suggests he is too cheap to pay for the blue check mark. But you also have other agencies as well suggesting this. I mean, LeBron James, though, somebody who's worth somewhere around $1 billion, which makes this pretty incredible. But beyond that, the LA Times, the New York Times, the Washington Post, BuzzFeed, Vox, Political, CNN, all those agencies, by the way, lean slightly left. All of them suggesting, no, we don't want to pay for a blue check mark. Absolutely not. We won't pay for a blue check mark. Screw the blue check mark. And so it's kind of interesting because it's going a little counter to Elon's plan to monetize Twitter. Keep in mind also that in recent filings, you've had Elon Musk value Twitter at about $20 billion, which is less than half of the previous $44 billion valuation that Twitter had. It puts it at about 45 to 46% of the valuation. My hair is a mess right now, and I apologize for that. It's bothering me. I'm trying to fix it. But then again, I can't even really see it myself. Who cares? And I don't know why I'm getting distracted by that. So, if any of this makes you nervous, remember, you can always get life insurance in as little as 5 minutes. You can also get 12 free stocks by going to metkevin.com/Weeble. And you could use Buy Now, Pay Later to make sure that you see, look, we put the little banner up, but I didn't put myself in the right place. There we go. That's better. See, look at that. Now above my head, you can see we have the CPI coupon code now live. It is the 69% off coupon code. The prices did move up a little bit from last time, but that's normal. We have a 69% off coupon code. And we continue to provide more and more value. Yesterday, we had a very, very value-filled course member live stream. We'd love for you to check it out. Our most popular payment method right now is Buy Now, Pay Later. And you can use that as well by going to metkevin.com/join. All right. So that puts an end to the Elon Musk and FTC segment. And let's now head on into the next segment. Oh, yeah, this is a fun one. I actually have quite a few fun ones. Sometimes I actually have more fun on the weekend analysis, and some people, they leave me comments. They're like, Kevin, why would I listen to your stream on the weekend? There's no news on the weekend. Maybe there's not news, but there is financial insight and analysis that actually, I think, kind of has more importance on the weekend because that's when people are putting their thinking caps on. Who knows? Cheers to coffee. Look, isn't this cool? I'm like in a dungeon over here. Seriously, here, let me give you like a little tour really quick. You ready for this? I hope I don't break anything. We got like the dungeon-esque fireplace over here. Isn't that cool? And then look at this beautiful chandelier over here. Isn't this crazy? It's really, really cool. So I'm actually honored to be staying here. Very, very cool. It's very nice. It's up in the mountains. Okay. The next topic is really, really fun. So I'm excited for this next one. And it involves me drawing, which if you like my drawings, you're going to like this one. But first, I'm going to take a sip of this coffee. Live streaming at Luigi's mansion. Looks like medieval times. This house is absolutely gorgeous. Really, really, really cool. Maybe I can give you a little bit more of a tour. Would you like more of a tour? Let me see if I can do that. But you can't see, I can't get near any mirrors because then you might see that I'm not wearing any pants. Let me see if I can do a tour. All right, we'll call it a tour really quick. It'll just be like a little mini tour because I don't want to go wake everybody else up. So mini tour, enter. How am I going to do this? Enter studio. Okay. Now keep in mind, this is exactly why you want to go to metkevin.com/StreamYard, because if you go to metkevin.com/StreamYard, you'll be able to learn how you too could do. There we go. Mute that. Okay, I think I've accomplished solo layout. We'll get to my drawing in a moment. All right. I could actually probably flip El Camera. Let's do that really quick. Let's flip the camera. And then we'll have to flip the audio source too, because otherwise I'm going to lose y'all. Okay. Very nice. Look at that. Now let me flip the audio source. Audio. We will go from Yeti to the iPhone. Okay. I'm causing problems. This might be a little more complicated than I thought. No, it should work. Let me try. Can you hear me if I do this? Does that work? Can you hear that? Give me a thumbs up if you can hear that. Hopefully there's no echo on that. Okay, well, let's see what happens. Can you hear this? Can you all hear this? Yes, yes, yes. Okay. All right. I would move. Can you hear it now, or does it get really quiet? Anyway, look at this. And you can still hear this? Or is it really quiet now? Okay, cool. Thank you. Look at this. How cool is this? Beautiful piano over here. It's pretty dark. I wonder if I can turn on the light. Yeah, right now it should be on the, look at this great room. Look at that chandelier alone. How nice is that? This is where the surround sound is. You see the surround sound up here in the ceiling? And then not only do you have the surround sound over here, you might notice there's no TV, right? So the TV is actually in there. I don't know how to make it come up, but apparently I can also, I believe I just, oh, there it goes. Look at that. Super cool. How huge this is. It's really gorgeous. Well, look at this. This is just, I imagine one of these buttons would probably make the TV come up, but I don't want to mess it up. The TV actually comes out from there. It sort of drives up. Which is crazy. Really, really cool. Fair. I mean, look at it. This is so cool. Yeah, I don't want to push buttons I don't understand. But anyway, this is gorgeous. I mean, just look at even the range over here. Super cool. Really, really nice. Wow. I mean, even the sink. I mean, this is like a child's bath. So beautiful and very, very tasteful as well. I mean, the carpentry over here, even going as far as, the staining of the edges of the carpentry, right? Like this is all a lot of effort. Really, really cool. I mean, look at that light fixture alone. That's probably like a $20,000 light fixture right there. Really cool. Yeah. And scales. The scales of justice. Here are your built-in fridges. Freezer, fridge. Another sink, because, this is like where the butler uses the sink. You wouldn't want the butler using the sink over here. Anyway, all right, let's get back to work. Look at these. How beautiful is this? I mean, these are probably like $2,000 a piece, man. I wish, now it would be really cool if you could disconnect this and then walk around with it. And it just like battery charges or something. That would be sick. That would be really cool. Let me see if I can open up the, oh, that's a pizza oven, by the way. That's a pizza oven. That's pretty cool. If I go somewhere over here, I can actually, I believe I can do, oh, that does these. Oh my gosh. How cool. Unfortunately, it's really early. So, can you see anything? Let's see. Not quite yet. A little bit of snow. Anyway. Super cool. All right, let's get back to work. Go over here to my little area by the pizza oven. All right. All right. Are we okay again? Are we back? Oh, no, hold on. Let's get back to the microphone. There we go. We should be back in action. Should be the good microphone. And bro, it's real RuneScape in real life. Yeah. Yeah. The window was a mirror. Yeah. Where's the torture chamber? That's downstairs. All right. Very good. Maybe they're from Restoration Hardware. House Hack is not buying these. You're right. House Hack is absolutely not buying these. All right, folks. Let's get into the next topic. So, what am I going to call the next? Love the undies? Oh, you saw my undies? No, I'm not in undies. I'm not wearing undies. Oh, y'all are ridiculous. I love it though. All right. This is coming to me for $0 a night. I feel honored and blessed. A very, very nice family is letting me stay here. They are the nicest people. Some of the nicest people I've ever met. All right. Let's talk about the bear stranglehold. We got to get back to business. Well, folks, Bloomberg is back at it again. Bloomberg's Lou Wang just posted a pretty fascinating piece on how potentially the market rally that we're seeing is actually being propped up by none other than the bears. Listen to this. Lou Wang suggests that skeptics and bears are really what's keeping this stock market rally going. They say, quote, "Rarely has the consensus been more uniformly bearish than it is now. In fact, investors are sitting with the lowest allocation to United States stocks in almost 2 decades." Listen to that, 2 decades. We are at the lowest allocation to US stocks in 2 decades. I'll say it again, decades. And US investors have held on to cash since the longest stretch since the dot-com crash, which also happened to have been about 2 decades ago. Why? Well, obviously. Why not? The banking system is stressed. We have high yields on treasuries and high yields on savings deposits. We have recessionary warnings all over the place, suggesting that the depth of the recession via the inverted yield curve is still substantially ahead of us. And those of us who study the inverted yield curve know that the bond market is giving us a flashing red warning sign that it is not the inverting of the yield curve that is painful, but it is indeed the re-steepening that will lead to an earnings recession and crush us all and leave us all buried into a dungeon. But when everyone is leaning one way, it's not a surprise that the market is leaning the other way. The S&P 500 year to date is up 7%. Some actively managed ETFs that won't be mentioned are up 30 to 40% year to date. The Nasdaq is up 23% year to date. Goldman Sachs literally wrote in an investment piece that there are, frankly, quote, zero bulls out there right now, and that 85% of respondents to their survey, 85%, were either bearish or neutral. And to those folks, I have nothing to say other than make sure to get life insurance in as little as 5 minutes, you darn bears. And yes, I am paid to say that you can get life insurance in as little as 5 minutes by going to metkevin.com/life, right next to the link where you can get 12 free stocks for Weeble at metkevin.com/Weeble, right next to the link where you can get 69% off by using the CPI coupon code, which will expire April 12th on the day of CPI, and you'll get the latest best price guarantee going forward. Now, continuing on, we must talk about Bank of America's Money Manager Survey. Bank of America's Money Manager Survey sees the allocation to United States stocks at an 18-year low. Listen to this. Goldman Sachs sees zero bulls out there. Money Manager surveys at Bank of America, 18-year low. We have the longest stretch of holding cash since the dot-com era, and we are now deemed uniformly bearish. And maybe the bears are right. Of course, I'll be responding to this, but consider this. Of the previous 14 bear markets, there have only been 2 times that the S&P 500 has had back-to-back quarterly gains. We just had our first quarter gain of 7%. That means we have a 2 in 14 chance, according to history, of actually ending this quarter green for the S&P 500. And the only times we've had 2 back-to-back S&P 500 quarterly gains in a bear market were in 1981 and 1938. The only other explanation might be that maybe the bear market is over and we're in an official new bull market. After all, the NASDAQ climbing 20% since the beginning of the year has officially entered the NASDAQ into a new bull market. However, maybe the bears are more right, that the earnings recession and the bottom of the market is still ahead of us. After all, the start of a recession is typically when stocks bottom, and recessions generally don't happen until the yield curve re-inverts. That is, it goes to uninverted. Also, we typically don't see the bottom of a stock market until about 6 months before earnings bottom out. And usually when the Federal Reserve pivots, it's actually a sign that the market has more pain ahead of us. Now, of course, I have countered the pivot argument many a time before. You could just type into YouTube, Meet Kevin Fed Pivot, and you'll find at least 4 different videos explaining why this Fed pivot will be different. But I have a different explanation today to try to help educate some of these bears. But there's still more bearish information. The more research just came out today and suggested that this is the first time we ever had a contraction in the M2 money supply, falling 2.4% year over year since 1961. Since 1960. And it potentially suggests that we have a lot more pain ahead of us. The actual true effects of quantitative tightening are still to come. So the bears are arguing, that the economy is running on fumes. Well, I have a response to this. I have a drawing. And of course, nothing could be more interesting than a drawing from Meet Kevin. So let's pull up the drawing from Meet Kevin by clicking a few quick buttons here. I click that button. I click that button. Ooh, that's juicy. Look at that. So thanks again to StreamYard, by the way. Remember, if you go to metkevin.com/StreamYard, you'll be able to use this software as well. You'll also get a free trial, so you'll save some money with it, which is pretty cool. In fact, right now, as I was saying that, I actually uploaded a new banner, and watch this. I'm going to push this button. Look what happens. Boom. How I live stream, metkevin.com/StreamYard. Isn't that cool? I just flip between different banners like that. In fact, we actually made quite a few of them, which we think are kind of cool. Let me upload some more of these. Look at this. I made a life insurance one. Easy life insurance, paid promotion, metkevin.com/life. Look, I made a house hack one. I'm having too much fun with this. This is actually really cool. I kind of really enjoy this. Anyway, okay, let's look at my drawing. So going to my drawing now. So this, folks, look at this. Okay, so this is what I wrote is a normal crash. You ready for this? I'm on my iPhone, right? There we go. Okay, so a normal crash looks like this. First, the bubble pops. This right here, we'll call it the GDP line. So the bubble pops, prices quickly go down. Then the economy enters or starts signaling a recessionary environment. And usually when the economy starts suggesting a recession, the Federal Reserve begins to cut rates. So think about that. The Federal Reserve actually begins to cut rates as the economy is starting to show signs of entering into a recession. Then markets continue to fall, and then the recession actually begins. And then the earnings bottom generally occurs about 6 months after the bottom of the stock market, but we're already in a recession. And usually in a recession is where the market bottoms. This, folks, is a historically normal crash. Again, bubble pops. We start seeing recessionary signs. The Federal Reserve panics and cuts rates. The market falls more. We hit bottom. which is about 6 months before the earnings bottom, and then we slowly get led out of the recession, generally by growth stocks. Okay, so now what is this time? And keep in mind, the most dangerous words today are "this time is different," right? And that is the most dangerous thing you could say in a recession. But I'm going to show you the potential "this time is different" chart. This is my opinion. I drew this. I think it is a consolidation of all of the research that I do. So what do we have up here? November of 2021. What do you have? You have, well, bubble pops, right? And the stock market ends up falling at 3 times the speed that we fell in 2000. So in other words, this stock market crashed 3 times as fast as the 2000 stock market crash. That's pretty incredible. That is a very rapid fall. And so then we had this sort of W-shaped bottom around the same time that we actually had a technical recession. We were technically in a recession when the market first bottomed in Q2, Q3. July to October was our first stock market bottom. We had another bottom in many stocks in December thanks to tax loss harvesting. Then we had rebuying in January. A lot of rebuying in January because, well, obviously the people who tax loss harvested wanted to rebuy because of, well, maybe FOMO or what have you. Then we had fear in February that January was too strong, so we traded relatively sideways in February rather. But now we're starting to get data that suggests maybe inflation is actually going away. The February PCE data was actually phenomenal. Now, of course, we're going to be getting our CPI data here on April 12th, which is when that next coupon code will be expiring and the prices will go up again for the programs on building your wealth, and you get that price guarantee. But take a look at this on the right over here. I believe that the Federal Reserve will actually not cut because of a recession or otherwise. I actually think the Federal Reserve cutting has absolutely nothing to do with whether or not we enter a recession. We could have been in the recession here in 2022 as a technical recession, or we could potentially enter a recession over in this blue area on the right. So the blue areas here are, in my opinion, where we could be in a recession, either here or here. But notice the Federal Reserve does not actually cut upon us entering a recession. The Federal Reserve only ends up cutting when they are convinced that they have conquered inflation. And upon being convinced that they have conquered inflation, I believe the Nike swoosh takes hold. The market moons. Why? Because inflation is what's causing the strife we face today. There's nothing other than inflation that is causing the strife we have today. Yes, is it possible that we over-tighten? Sure. But as long as inflation goes away, I believe the fear of this crisis goes away. That's my take. We'll see. But it is my belief, and I think it's the belief that could be correct here. I am putting my money where my mouth is here. So even though the bears have their arguments, I actually think this Bloomberg piece is very incredible. When you have the Bloomberg author saying, look, everybody's bearish right now. Goldman Sachs, remember, says zero bulls out there. Apparently they're not watching Meet Kevin. Maybe they should. Subscribe. Thank you for watching. Then you've got, a Bank of America suggesting that the allocation to U.S. stocks is an 18-year low. I mean, it's no surprise that we could have a nice, slow, and steady recovery out of this mess, as long as inflation keeps trending down. What destroys my thesis completely is a resurgence of inflation. If inflation resurges, we're screwed. But so far, that's not happening. So knock on wood. I'm literally doing that right now. Knock on wood. And I appreciate you watching this segment on the bear stranglehold of recession. All right, next topic. All right. Somebody says trying to get a spot at CNN. Oh, I don't know. That sounds so harsh. I couldn't imagine CNN or Fox. It's just too polarized. I don't know. I'm too in the middle, man. I can't do it. Well, yeah. I mean, Jerome Powell acknowledging the ghost of Arthur Burns and the mistake of cutting too early is exactly why he will not cut until rates are until inflation is convincingly down. That reiterates my point. Right? All right. Next up. What should we talk about next? I actually have a whole list of topics that I want to talk about. Where did I put it? Oh, here we go. All right. The next topic. Oh, yeah. All right. This next piece, before I get into some other pieces, this next piece is going to be, it's going to start a little basic, but I want to show you some earnings calls in response. And I think the earnings calls will be very enlightening to you because they're all from the last week over here. But it'll start a little basic and then it'll get a little more detailed. Should we still be keeping 10% in cash? I mean, I can't, I can't give you personalized financial advice, right? You know that. But I'll tell you what my take is. So let me look really quick. What is my allocation to cash right now? We are sitting at 6.5% right now. And that's where we are right now. And again, that's not like a suggestion of what you should do. That's just my opinion. Okay. All right. Oh, Jane, your comment is perfect because it goes right into my next topic. So thank you. All right. Hold on. Right, here we go. 5 seconds. Well, folks, everybody is pissed at me because yesterday I made a video talking about PCE inflation and how wonderful it was that PCE inflation came in below expectations, and it looked like goods inflation was 0 and service inflation was finally disinflating to just 0.2%. And boy, oh boy, the comments I got were quite extreme. They were somewhat to the effect of one like this. For example, Jane just wrote, "Inflation is not going to stop. We will not stop buying." And yesterday, somebody else, which actually inspired this topic, somebody wrote, "What the F are you cheering about? Low inflation, my ass. When I go to the store, nobody is reducing prices and everything is still expensive. Kevin, you're smoking crack. You don't know what you're talking about. Unsub, dislike." All right. So let's start at the basics and dismantle this. And then I'll show you some earnings calls from just the last week. So these are not the traditional earnings calls that I've been talking about regularly through the cycle. They're actually brand new earnings calls. And we'll go through and look at some of the latest data. So let's first explain how inflation actually works. All right. So in order to do this, we're going to go ahead and show the little coupon code banner right here. That is your reminder to get in before the CPI coupon code expires. And then we're going to go to this little sheet here, and I'm going to draw you how inflation works. Again, this is going to start a little basic, and then I'm going to get into some new information on earnings calls. So I want you to remember this, because it seems like I have to regularly re-explain this. If something costs $100 at a store you're walking into, and you're pissed off because all of a sudden that object now costs $110, how much inflation did we just experience year over year? This should be relatively easy math. There was a positive 10% move in inflation because inflation could obviously be negative as well. This represents a positive 10% move in inflation. Now, if inflation does the following, and that $110 product is now $112, how much inflation did we just have? Well, for simplicity, okay, I know this is not a perfect math, but for simplicity, we had approximately 2% inflation. Notice that in this case, did the store, ask yourself, challenge yourself here, did the store cut prices in this case? Would the store have discount banners up telling you about how this price is no longer $110, the price has been reduced? No, the store would not do that because the store actually continued to raise prices. So your frustration is actually accurate because prices have gone from $100 to now $112. Prices are still high because prices have gone up. They have adjusted upwards. That is frustrating. But that is not actually what we're cheering. We are not cheering that prices are still high. We are not cheering that prices are not going down because obviously we would love for prices to go down. What we're actually cheering is what's called an inflection point in the rate of inflation. So if inflation is moving at, say, 2%, and then all of a sudden it jumps to 10%, and then it goes back down to, say, 3% or 2% or whatever it is, the trend of inflation is towards disinflation. Disinflation is moving from 10% inflation to 2% inflation. That is disinflation. It just means the trend has now moved down. Inflation is no longer going up in its growth rate. Remember, inflation is a rate of change measure. So if you kind of relate that to a car, think about it like if you're slowly accelerating at a red light because you're trying to save your fuel economy, you're slowly accelerating like a grandpa, your rate of acceleration is very low. Your inflation rate is very, very low. But if you're somebody who drives aggressively, like let's say a newly licensed teenager in a BMW, you might floor it on the gas, which is similar to printing a lot of money, and you create really fast inflation. And then you hit the brakes, and then you stop the economy really quickly, right? That's kind of the jarringness that we're experiencing here. Now, note, what we are cheering again is that disinflation is occurring. And what we're looking for right now in the economy are signs of disinflation. And this is where I'm going to introduce you to 3 different earnings calls, all from the last week, to give you a little bit more color on how disinflation may occur. Keep in mind that deflation would actually be prices coming down. So if that $112 went down to $111 next year, then you would have, again, for simplicity, approximately a 1% decline in inflation, which is deflation, right? Negative inflation, deflation. A falling rate of inflation is disinflation. Okay, now let's look at some earnings calls. So let's zoom into this earnings call here. This is Darden. Okay, this is Darden. Darden is the company that does restaurants like Olive Garden, Longhorn Steakhouse, Cheddar Scratch Kitchen, blah, blah, blah. Okay, fantastic. So what do we have here? We significantly exceeded the industry's benchmarks for same-store restaurant sales and traffic, outperforming more traffic than we did on sales. So traffic is outperforming the competition. However, what did the company do? The company continued to underprice inflation, resulting in lower overall check growth relative to the industry. So what they're saying is we're getting traffic, but we're not raising prices as much as inflation is going up. Folks, there are 2 letters that this company does not have as much of. What are those 2 letters this company does not have when you have an earnings call that says we are not raising prices as much as we could have? Well, folks, it should be obvious. This company lacks pricing power. It lacks pricing power when it is not able to raise prices with the level of inflation, because what's happening is their margin is declining, right? Margin decline is very, very normal. And then what we can do is we can compare margin decline between various different companies and say, well, whose margin is likely expected to be most resilient? Which company is then high free cash flow and with the most resilient margin? And those are typically the companies you want to be in this sort of time. Okay, fantastic. So what else do they tell us about inflation? Well, they tell us, look at this. Food and beverage expenses rose 1.1%, driven by commodities inflation of about 9%, which was higher than we anticipated going into the quarter and significantly outpaced pricing of 6.3%. So this is a red flag here, right? Because some food and beverage inflation is still happening. But look, inflation is going up by 9% in certain food and beverage categories, but they're only raising prices at 6.3%. That shows you a lack of pricing power. Now, take a look at this. Chicken, dairy, and grains continue to be categories experiencing the highest levels of inflation for Darden. However, they have improved versus the prior quarter as we expected. However, beef inflation improved. This is one of the reasons we like to take out food out of inflation measures, because it is so volatile, right? So look at this. This shows us that restaurant labor was 120 basis points better than last year as we benefited from sales leverage, good, trying to run more efficiently, despite hourly wage inflation of 8%. A lot of year-over-year measures, these are year-over-year measures, most of these, for wages and food are still very high. This is normal. This is actually reflected in CPI and PCE, that you're still seeing that sticky service inflation year over year. That's normal. But it looks like some of that is starting to wane. Why is it starting to wane in services? Why would I show you a restaurant that is saying, hey, man, some of the inflation is still high? Well, I'm doing this because we're starting to see the company say, look, even though some of our input costs are higher, we're not able to raise prices anymore. Eventually, that actually reduces CPI. Because when you have a company that says, look, our PPI is high, our producer price inflation is high, but we're not able to raise prices matching our PPI. What happens when PPI is not passed on to the consumer? CPI falls. And that's what we want to start seeing happening. So we're starting to see the crack at a sector that historically has been doing very well. So I'm purposefully looking at a company that is still showing you sticky inflation, but they're starting to show you the flip flop. What are they doing? They're looking at margin performance. Why? Because they don't have pricing power anymore. Now they're talking about underpricing inflation. And in order to try to offset some of the increased costs, what are they doing? They're reducing their marketing spend, red flag for advertising. And they're going through other cost saving initiatives. So this is really a company that's telling you, like, hey, look, we're trying to get more efficient, but we're going to get squeezed here. So this is not a company I would want to invest in 2023 because they're getting squeezed. They're reducing their marketing. Well, reducing your marketing is a great way to potentially reduce your revenue. At the same time, you have cost pressures and you can't raise any more prices. That's a red flag. Total inflation for commodities expected over here. This gives you some numbers here. Expected. We expect commodities inflation between 9.5% to 10%. So some large sticky levels of inflation, right? Now, we expect commodities inflation that is solidly in the low single digit range for the fourth quarter. So they're talking about the last year we've had very high inflation. But now looking forward, what do we expect? Well, they actually expect potentially commodities inflation that'll rotate back to the low single digit range and potentially closer to flat. And going forward, they expect, look at this. And while we don't normally provide commodity outlook this early for the next fiscal year, we are anticipating low single digit inflation for the commodities basket in fiscal 24, led by high single digit inflation on beef and produce. We expect all other categories to range from slight deflation to low single digit inflation. What am I doing here on purpose? I'm trying to show you. I'm trying to teach. I personally believe, and I'm not trying to pat myself on the back. I really personally believe this. I personally believe nobody else analyzes this stuff. And what I'm purposely trying to do is I'm trying to go, okay, Jerome Powell says sticky inflation is the problem. Where's the sticky inflation? Restaurants and hospitality and retail. Okay, let's go to the epitome of that. Go to restaurants, go to Darden. What's Darden saying? Dude, the last year, we had hella high inflation for labor and commodities. This sucks. Our margin is getting squeezed. We have to become more productive. We have to cut advertising. This sucks. Going forward, we actually expect commodities, some of them, to disinflate. Beef is still going to hurt us, but everything else is going to be low single digits. And overall, we think we're going to have low single digits inflation. So now they're telling us they're not raising prices and they're expecting low inflation. That's best case scenario. The problem is, folks, what I just showed you is called a leading indicator. And that's not the only company I'm going to show you. I've got a few others I want to tell you. But this, folks, is a leading indicator of disinflation. Leading. CPI and PPI are laggards. They lag. They are lagging indicators. This is why people are fed up with the Federal Reserve being focused on lagging indicators, because they believe the Federal Reserve will over-tighten by looking at lagging indicators, when it's actually the restaurants that are telling us, we are actually potentially looking at a down inflection here of inflation. Very, very good to know. Thank you for that comment, Rosie. You're right. I did make a mistake on that. And I actually mentally thought about that. So the comment here publicly is, I made a mistake by mispronouncing a Mrs., or I said Mrs., but they're actually a Ms. A Ms is generally either not declaring that they're married or are unmarried. And then a Mrs. is a suggestion that you are married. I'm really bad with like these little acronyms and pronouns and stuff. I'm trying to get better, but thank you for pointing out my flaw and helping me learn. Okay, next earnings call that we have to look at is this is actually one of my faves. We're going to look at the Dave and Buster's earnings call, but we're going to be very brief about our business here. I want to jump in over here. This is the financial position page. Hold on. Where is it? Where is it? Where is it? I think it's right here. Here we go. Look at this. I'm going to start with labor inflation. We are seeing some relief here. What have we been talking about? Remember, how many times have I said Starbucks, Chipotle, and all these various different companies, Uber, Lyft, are giving us the heads up that labor inflation is going away, that there's no wage price spiral? And you know how many times I got pissed off, or people got pissed off at me about that? Yeah. Ooh, somebody noticed. Somebody, by the way, just commented, thank you for using the banner at the bottom of the stream instead of puking ads, Kevin. That's true. This individual is thanking me for having at the bottom of the stream here, get life insurance in as little as 5 minutes, paid promotion, and sign up for 12 free stocks with Webull by going to metkevin.com/free. We just have a scrolling banner down there so I don't have to read it out. And look, there's even one for Kevin's ETF and courses, meetkevin.com, whatever, they all go. Kind of cool. Even though I just read them all out. Anyway, okay. Ooh, somebody's making fun of me saying restaurant is your leading indicator. LOL. No, actually, a consolidation of all earnings calls are my leading indicators. Remember what I just mentioned: Uber, Lyft, Johnson and Johnson, Procter and Gamble, Tyson Foods and Industrial. It's not just restaurants; it's everything broadly. You can easily look at Cloudflare in the tech space. You could look at the availability of labor. It's insane. Cloudflare had 400,000 job applicants for 1,300 positions. It's crazy. All right, so what do we have here? Dave & Buster's. I'm going to start with labor inflation. We are seeing some relief here. I think when you look at hourly wages quarter sequentially, so quarter over quarter, they stayed relatively flat. Holy smokes, folks. How could you bet that we are going to have hyperinflation when the leading indicators are obvious? Flat, 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 flat. Now Dave & Buster's telling you, we feel that we've stabilized. And the same for commodities. We've actually seen a nice decline. So when you're looking at, call it quarter sequential inflation, which means quarter over quarter, we went from about 17% year over year and came down and down and down. And in Q4, we saw inflation at just roughly 4%. We've been able to get commodity inflation down. We're looking at relief around proteins like chicken breasts and wings. This is good. This is good. This is actually very, very good news. Let's look at one more. Can we get underwear inflation? The only underwear inflation that exists are these short shorts that I'm wearing. I gave everyone a little preview of them yesterday in the course member live stream. You'll have to check that one out. But these are amazing. These are $19. I shared them all with course members, and they're a godsend. I love them. They have little zipper pockets too on both sides. Dude, let me just rant for a second here, okay? This is deflation in a good way for you. I went to, and then we're going to talk about, we have one more earnings call to look at. We have to look at Canadian Solar. I bought shorts at Hugo Boss, running shorts at Hugo Boss. And the Hugo Boss running shorts did not have, the Hugo Boss one's ripped. So the Hugo Boss one's ripped. And then I had an Aloe set of shorts. And the Aloe shorts, they didn't rip, but they didn't have any pockets. I'm like, what the hell? Each of those were like $60 shorts. One of them, the Hugo Boss ones rip, and I love Hugo Boss. The Aloe ones don't have any pockets. And I'm like, what the hell is this? So now I'm wearing $19 shorts. They're like a 3-inch inseam or whatever. But anyway, I'm wearing $19 shorts, and these are like indestructible. They don't tear. They don't rip. They're comfortable. I get them on Amazon. They're phenomenal. And I'm just like, why the hell would I spend more money? This cheap stuff is fantastic. Anyway, yeah, no pockets. That should be illegal. I know. No kidding. Yeah, you know, need that 3-inch inseam for the big pee-pee. Anyway, take a look at this. This is Canadian Solar. If you look at the past 2 decades, raw material costs increased meaningfully due to COVID. Recently, some of the raw material costs have started to decline. And that's disinflation for you, such as that of polysilicon, as new capabilities ramp up. But we are not quite at the bottom of the cost curve yet, given the technological innovation in pipeline that will help us basically lead to further cost declines. The key point is that we're getting very close to the bottom of the cost curve for solar, at which point value and technological differentiation become prominent drivers of profitability, not cost. With that, we expect to see greater PP and operating leverage as our cost structure stabilizes. Basically, Canadian Solar is saying they have no pricing power right now, but they are seeing commodity costs decline. I'm not a big fan of investing in solar panels because I basically think they're a commodity. I'm a big fan of investing in end phase solar inverters and batteries. Not a big fan of investing in the panels themselves. So something to keep in mind. So yeah. Anyway, so what do we learn from this? Well, we actually learn that disinflation is everywhere. It's all around us, the disinflation, and that's actually a phenomenal thing. Now, some of you have been asking how I put these banners up like this and how I've got the little scrolling thing at the bottom. Just go to metkevin.com/StreamYard, metkevin.com/StreamYard, and you could learn more. If you go to metkevin.com/StreamYard, you'll be able to play around with these. It's kind of cool. That is a paid sponsor, but StreamYard is a software that I've actually been using for years, and they're really cool. They set up a special for you if you sign up with them via that link down below. Let's see if you go to metkevin.com/StreamYard, just to make sure it works really quick. It should work just fine. But yeah, it does. Yeah, it also lets me have recordings of all this content, which is pretty cool. So yeah, go to StreamYard. Pretty neat. Some pretty cool tools. But anyway, so that concludes our segment on pricing power and inflation and the lack of inflation. There's my little paid promotion banner. So thank you so much for watching that segment. We'll move on now to the next one. Giving me RuneScape vibes. I know now, like the sun is coming out behind me. It's pretty cool. I gotta figure out how to get those blinds open. Let me see if I can get those blinds open, because then we'll be able to watch the sunrise for the next one. Hold on. I can't figure it out. Nope. Yep. Nope. I cannot figure it out. I'm sure the switch is somewhere, but I cannot find it. Oh well. Yeah, Kevin's getting all romantic with us today. It's so beautiful outside. It's all snowy and stuff. So, my traveling setup. Once I perfect this traveling setup, which I'm getting really good at it, I'm going to do updated lectures in our YouTube course on this. I have to say, this is probably nearly the most streamlined set I have yet. And it's actually still not perfect. It's going to get a few notches better. I have a few improvements for the next time I travel, but every time I travel, it gets better and better and better. I actually removed like half of the equipment I was using, so now I have a much lighter pack, a smaller package. It's not about the size, folks. It's never about the size. It's always about performance. All right, let's get to the next segment. Yeah, well, let's do this one. Okay, this is a short one, which is good, but it's really good. All right. Somebody says the stream is freezing for them. I haven't noticed any issue. Has anybody else noticed an issue? Hopefully not. Okay. Next, we are going to go right over. Oh, yeah. Yeah, this is a good one. Okay. Oh, okay. A little bit. Oh, that's unfortunate. Well, that's just, that'll be a Wi-Fi issue then. That's what happens when you stream in a castle, right? That's all right. We'll do our best to keep it going. Audio isn't. Okay, as long as the audio is good, I mean I could drop it to 720. And that would remove that. I'll just do that. I'll drop it to 720 there. So hopefully that solves the problem. No, I can't change it. I guess once I pick 1080, I can't downgrade. So never mind. Once you start streaming, okay, I'll just from here I'll stream tomorrow with 720, but I don't think I can drop while I'm live. No. Yeah, all right. Well, sometimes the throughput isn't that great on Wi-Fi where you go. Next time I'll just do 720, but that's okay. As long as you all can hear it, I think that's the most important. All right. Okay. Hold on. Let me close some of the these tabs that were streaming in the background. Looks like I had like some different fan streams up in the background. Let me close those. Okay, maybe that'll solve that. Right. Next up, globalization and hyperinflation. Huh? It's actually a good piece, and it's short. Mhm. One of the greatest fears of this recessionary cycle is that deglobalization will lead to the greatest hyperinflation of our lives. That it's not just the expansion of the money supply, making Austrian economists roll over in their graves. It is not just the money printing and stimulus that led to the greatest inflation since the 1980s for over 40 years, but is actually potentially the frustration that businesses face due to broken supply chains during the COVID pandemic that potentially will lead to deglobalization and therefore massive inflation. The argument is simple. You can't trust China anymore. You can't trust the existing supply chains, so everybody needs to reshore. And this argument has been made for years that as companies reshore their products and their manufacturing back to America, the costs of manufacturing will go to the moon. And if the costs of manufacturing go to the moon, folks, we are all screwed because we will feel nothing other than hyperinflation. And so I've written out this thesis on a document here, and then we're going to go into a piece from T.S. Lombard on globalization. Let me first give you this reminder. Remember the 2022 theme. We will have hyperinflation because you can't trust China. We're going to onshore all manufacturing. We're going to rebuild our own supply chains because we can't trust anyone. And what was Kevin's response? Kevin's response was very simple. In my opinion, this was my opinion, okay? My opinion was that thesis was ludicrous. If you've been watching my channel for over a year now, at least a year, you know that I've regularly said this idea of deglobalization and hyperinflation is ludicrous. My thesis was, why would you let one supply chain snarl ignore or lead you to ignore the cost benefits of lower labor costs in other countries? Remember, that is also a benefit to other people, right? When we bring jobs to Mexico, where the average hourly wage is $3.50, and we build a Tesla gigafactory there, what does that actually mean? It actually means you're creating more demand for labor in the area, which gives wage earners more pricing power, which allows wages to go up. But it's still cheaper than what you could manufacture for in America. So it's disinflationary for Americans. and it helps grow a market wherever we go. So I called for something known as reglobalization. You know this. We've talked about this pretty regularly. I've regularly talked about reglobalization as my thesis for what would happen. And I believe, and at the same time, we've seen Apple then move to India, Vietnam, and Mexico, gaining a lot of clout along with Indonesia, Taiwan becoming basically an area known for its advanced chip making now, especially with Taiwan semiconductors. But then we also have China now freaking out and realizing, oh my lord, we may have messed up. How can we get American companies back? This was a big deal, right? And China, after all, with Xi Jinping making his conference in front of the Chinese Communist Party, applauding central planning and socialism, but for the first time nearly ever, applauding capitalism as something that would be a priority for them. And now inviting whom? Well, not only American companies back, but recently meeting with Tim Cook and meeting again soon with Elon Musk, the premier, inviting Elon Musk back to Shanghai. Why? So they can brag about the success story of American manufacturing going to China. That's what China's good at. They've become really good at manufacturing. Consider what Foreign Affairs told us about China. They told us that the Chinese, when they decided to go all in on solar panel manufacturing, not only did they make the cheapest solar panels, but they made the best solar panels. So, what do we finally have the institutions now saying? Well, look at this, folks. I feel vindicated. I feel vindicated. T.S. Lomgard, the future of reglobalization. I saw this and I just about fell off my bunk bed this morning. I cannot believe that I actually have now, for the first time since we've been talking about this for years, actually seen an institution finally talk about reglobalization. I could not be more happy. I could not. I'm so happy. My heart is palpitating at such high levels. I have to remind you to get life insurance in as little as 5 minutes by going to medkevin.com/life. See, look, I changed the banner. I changed the banner so quickly because I'm streaming and bringing this stream to you via the paid promotion of StreamYard. medkevin.com/StreamYard to learn how I bring this stream to you. It's pretty awesome. Right next to the links for building your wealth link down below and the courses. Okay, so the future of reglobalization. What do we have here? Well, hyperglobalization may be over, and the US-China decoupling may actually be fueling not a deglobalization, but a reglobalization. And in other words, Mexico, Vietnam, Taiwan, India, Indonesia are the future. These are now the winners as global companies, international, multinational companies seek to rebuild global supply chains. And Mexico will be a very large beneficiary of not only the Inflation Reduction Act, but the move away and out of China. China is then widely expected to fight back against Mexico and India and Indonesia trying to take this expansion. The more Mexico, India, and Indonesia take business from China, guess what happens? The more China tries to incentivize manufacturers to go back to China. Folks, what happens when China tries to incentivize people to go back to China because people are now fleeing to India and Vietnam or Taiwan? You have a pricing war. You have lost PP. The manufacturers, the manufacturing nations have lost their PP. Their pricing power is waning. Well, the legacy ones, right? The legacy manufacturer of China is losing its pricing power. Instead, you now have more people wanting to share PP. As a result, American companies, multinational companies, the Teslas, the Volkswagen, the Fords, the GMs, the massive ones like obviously the Apples, the Microsoft, they all benefit. Enphase, massive international producer now of ASIC-based microinverters, building factories over where Top G has finally managed to go from jail to house arrest, allegedly, according to the BBC. We'll see what ends up happening with that. But anyway, we'll see. So focusing here on what this means. Reglobalization, folks, is a fancy way of saying prepare for big, fat, thick deflation. Yes, big fat deflation. I believe that this competition between China losing what it was once good at and everyone else will actually likely lead to more deflation, especially as India and Indonesia and Taiwan realize they have a limited window here before China slaps back. Now, keep in mind that in the past, India has failed at becoming a low cost global tech hub. Why? Because of labor laws, infrastructure, and bureaucracy that continues to constrain the managing sector. Let me give you a simple explanation as to why this happens in India versus China. China is centrally planned. China is communist. We know this. But they are starting to enjoy some of the benefits of of capitalism, right? But in a centrally planned economy, what do you have? You have the ability to streamline construction. You can build a gigafactory in Texas or Berlin in 2 years. You can do it in 1 year in China. And the reason you can do that in China is because you have central planning. Xi Jinping can pick up the phone and say, get it done. And then it gets done. Water lines are built in 40 days. The sewage systems, the plumbing systems, the electrical grids, everything gets re-engineered to accommodate Tesla via central planning. That is one of the fantastic benefits of central planning. Central planning in China is deflationary for America. Recognize that. Now, what about India? Well, India is very different. India's government is like a fractal system where every local government, the more local you go, the more the rules are different. There's no consistent permitting between different locales and municipalities. There's no central planning. Everything is based on whose pockets are getting lined more at the local level. And now, look, I'm not trying to suggest that India is corrupt. I'm trying to suggest that it's a developing country and there's obviously going to be less transparency than in other countries. But the point here is T.S. Lombard is making a clear argument that maybe it's not as easy to say, oh, let's just go to India or Vietnam. And China realizes that. And that's why I think China over the next year is actually not going to be a massive negative for America. It's actually going to be a massive boon for disinflation. So this call for reglobalization, I think, is fantastic, especially since now we're moving to this idea of going from a just-in-time style of manufacturing to a more of just-in-case model. This is really a way of, okay, let's understand that really quickly. Basically, companies generally don't like holding inventory on their shelves because it rots, it gets stolen, it decays, it depreciates. So usually if you're manufacturing a car, you want the wheels for the car to show up the minute that you actually need them, not any sooner. That's very important for keeping your costs down. Very important. But what's incredible here is that now companies are running such more resilient supply chains that once they actually move to more of a just-in-case model and they have more inventory on the shelves and much smoother supply chains, we will probably go from normal supply chains. Like let's draw that out just to understand the thesis of deflation here for a moment. If this was your normal supply chain and the supply chain got very, very expensive because of COVID, and now the supply chains are becoming looser, you will probably, through reglobalization, you will probably have cheaper and looser supply chains than you ever had pre-pandemic. So the pandemic might be exactly what we needed to end up creating less inflation and more disinflation, potentially deflation. It's actually a fantastic piece here on why disinflation could be coming thanks to reglobalization. Now, there is still the fear that there will still be political strife between China and America. After all, China is being labeled as a foreign country of concern or a foreign entity of concern, which actually limits some of the benefits of manufacturing in China and limits some of the tax credits of businesses being able to do business in China who also want to take tax benefits in America. In fact, there was just a massive piece. Let me see if I can pull it. There was just a very massive piece about how chip companies will potentially have to choose China or the United States. It's actually very relevant to this discussion right now. Let's go ahead and pull that up. And while I don't think that will end up being true in the long term, I think in the near term, that could be a choice that businesses have to face, especially since you're seeing that as well with, I think this was like a Barron's piece or something like that. Uh, but anyway, especially as you're seeing that with now, there we go. Found it. It was a Wall Street Journal piece. Let's go ahead and pull this up together. We'll look at this together. Oh, it's gonna make me go vertical. That's lame. No, I don't want to do that. Let me see if I can get it on my laptop. But anyway, the argument is that, well, I mean, maybe you can get disinflationary deglobalization, but if politics stand in the way, then what you actually potentially risk is more inflation in the short term as basically companies try to get their tax credits in America. But by getting the tax credits in America, you're actually printing stimulus checks again, right? I believe that. I actually believe the biggest stimulus checks that are going out right now are going to chip companies and energy and battery based companies. There's a reason my biggest exposure right now to stocks is in the space of chips and energy because that's where the stimmy checks are going, folks. And after all, remember, I'm your stimmy check expert. uh, anyway, so let's look at this Wall Street Journal piece because it gives us some really good insight. Stand by. I will share the screen thanks to StreamYard. Let's see how easy it is. Oh, that is so easy. That is nice. Actually, can I do this? No, that goes to my phone. This works pretty well. That's interesting. I'll have to play with my little default settings a little. Ooh, that's kind of cool. That's not as cool. That's not as cool. This is pretty cool. I love this thing. The software is so cool. Anyway, okay. So for chip makers, a choice between US and China looms. The semiconductor companies seeking federal grants under the CHIPS Act could face a tough decision: take Washington's help to expand in the US or preserve their ability to expand in China. The Biden administration last week proposed new rules detailing restrictions chip companies would face on operations in China and other countries of concern if the companies accept taxpayer funding. Some of the proposed restrictions, known as China guardrails, were tougher than the industry expected. Lawyers and national security analysts said they expect blah, blah, blah. Basically, now there's the potential, because of these stricter restrictions, that basically companies might have to decide: do you want to manufacture a lot of your pieces or parts in China or not? Now, you could potentially manufacture non-essential. What the heck is iPhone yellow? You could potentially manufacture non-essential goods in China. These could be non-advanced chips, or they could also be chips such as parts in cars that are not advanced or non-battery related parts in cars. You can still manufacture cars in China. So Gig of Shanghai doesn't get killed. It's just a lot of the assembly and battery tech has to be done in America. I really think companies, I really think, let me put it this way. I think a lot of this is unnecessary fear, uncertainty, and doubt. Now, notice that's a difference from just calling it FUD. But I think a lot of it is unnecessary because I think companies will be smart and they'll adapt. See, look at this. Samsung is building a $17 billion facility in Taylor, Texas. Oh, that's interesting. I didn't actually know that. I'm going to look up Taylor, Texas. Maybe that'll be a place for house hack. Taiwan Semiconductors is building outside of Phoenix. You've got Intel building like crazy in Ohio, I believe it is. But you also have now a partnership between Tesla and CATL expected to be built in America. It's being molded apparently right now. Tesla said to be molding battery plant partnership somewhere in America. This is all to end up getting the tax credits. So that's why I think there's potentially a little too much fear, uncertainty, and doubt, because I think these companies will just manufacture in America. That could increase costs. But here's another thing that nobody's talking about right now. You could literally just move this type of manufacturing to Mexico, and you could get the benefit of the lower cost of doing business, while also potentially getting the tax credits, right? So you could get the lower labor costs. I mean, this is all of these acts that we have passed, in my opinion, are just a literal boon to Mexico. It would not surprise me to see like maybe even like an Apple assembly plant or some form of Apple manufacturing. There we go. In Mexico, so that way you can get North American credits when they're applicable. If you need to get energy credits, manufacture your ASICs for Enphase in Mexico. In the meantime, we saw this ad for a yellow iPhone. I did not know they were doing a yellow iPhone. This is just me getting distracted by a squirrel, basically. But yeah, they've actually come out with more colors here. Look at that. What is this? Purple? My goodness. I guess the yellow one's the new one. It's actually kind of cool. I like that. Anyway, I don't know why I got distracted on that. I think this is somebody here on Twitch just wrote, can we talk about the attack on the petrodollar that nobody is talking about? Well, apparently you missed my video where I literally went into detail on this yesterday. So if you type into YouTube, Meet Kevin, petrodollar, let me get you the exact title of the video. Oh yeah, here it is. The Collapse of the Dollar, the End of America, and the Rise of China. Now, I was actually extremely proud of this thumbnail. I made this thumbnail, and let me click the right button here. Which button do I want? This button. Yeah, look at that top thumbnail. How sexy is that? I mean, look at that thumbnail. I mean, it's like the dollar, but it's like a zombie dollar. But anyway, if you type this in on YouTube, you will learn everything you need to. Look, it even says hashtag petrodollar. See that? The collapse of the dollar, the end of America, and the rise of China. If you have not watched this video yet, I highly encourage it because it will tear apart your fear of the petrodollar here. So anyway, okay, good, very well. So now A+ Photoshop work. Thank you. Now, I have to run to the Elite Hustlers course member live stream, so I highly appreciate you all being here. I absolutely encourage that you make sure you take advantage of the 69% off coupon code by going to metkevin.com/join. Make sure you go to metkevin.com/StreamYard to learn about how I did this stream today. Make sure you go to metkevin.com/life to get your life insurance in as little as 5 minutes, which you can Apple Pay or Android Pay for. And of course, make sure you get 12 free stocks by going to metkevin.com/Weeble. 12 totally free stocks by signing up at Weeble. metkevin.com/free. You could sell those stocks right away. And folks, we'll see you in the next one. Thank you so much. We'll see you in the Elite Hustlers live stream for Saturday morning.